As we head into 2025, the investment landscape is experiencing significant changes. After years of a strong bull market, investors are now facing new uncertainty. Inflation is higher than anticipated, interest rates are increasing, and geopolitical conflicts are present. This is a time for careful consideration. It's important to be agile, adaptable, and to understand the forces reshaping the market. Traditional strategies may need to be updated. There is a shift from growth stocks to value stocks. Bonds are becoming more attractive as yields rise. Alternative assets such as real estate and commodities are gaining interest. While the market may be volatile, with the right approach, there are still opportunities to profit. January brought some interesting developments for investors. After starting the year positively, markets experienced a decline as inflation data exceeded expectations. The Dow Jones Industrial Average decreased, and the tech-heavy Nasdaq saw a more significant drop, while the bond market also faced challenges. Is this a temporary fluctuation or an indicator of future trends? The outcome, as always, is uncertain. Some analysts believe the correction was expected and anticipate ongoing volatility. Others view it as a buying opportunity, maintaining a positive long-term economic outlook. Time will reveal the correct perspective. One certainty is that investors should be prepared for various scenarios. This involves having a plan, adhering to it, and making decisions based on logic rather than emotions. For years, the stock market has been led by a few major tech companies: Apple, Microsoft, Amazon, Google, Facebook. These companies have significantly contributed to the market's growth, overshadowing other sectors. However, the market dynamics are evolving. With rising interest rates and more selective investors, the FANG stocks are under closer examination. Their valuations are being reassessed, their growth potential is being reevaluated, and their dominance is being reconsidered. This shift from mega-cap tech is opening up opportunities in other market areas. Value stocks, which have been less popular in recent years, are beginning to gain interest. Small-cap stocks, often overlooked, are starting to show promise. This doesn't mean that big tech is no longer relevant. It simply suggests that investors should be more discerning. Instead of following trends, focus on companies with strong fundamentals, consistent earnings growth, and fair valuations. Section 4. Cash is king, but for how long? Understanding the money market surge. In times of uncertainty, cash is often seen as a safe haven. And currently, there's a significant amount of uncertainty in the market. This has led to record inflows into money market funds. Investors are moving away from riskier assets like stocks and bonds, preferring the safety and liquidity of cash. However, there's a consideration to keep in mind. While cash may provide short-term security, it is not a strong long-term investment. Inflation reduces the purchasing power of cash over time, and with current inflation rates, holding too much cash can negatively impact your portfolio. So, what is the right balance? It depends on your individual circumstances, risk tolerance, and time horizon. Generally, it's advisable to keep enough cash to cover short-term expenses and emergencies. The remainder should be invested in a diversified portfolio that aligns with your long-term goals. Section 5. Bonds are back. Navigating the new era of yield. For years, bonds have been overlooked in the investment world. With interest rates at historic lows, bond yields were minimal, offering limited income or potential for capital appreciation. However, the bond market is experiencing a resurgence. As interest rates increase, bond yields are rising, making them a more attractive option for income-seeking investors. With stock valuations appearing high, bonds are once again becoming a viable alternative for investors looking to diversify their portfolios. Naturally, investing in bonds comes with its own set of risks. As interest rates rise, bond prices typically fall, and with inflation still a factor, investors should be aware of the potential for reduced purchasing power.